So today what I thought we talk about policies, but notice I didn't say a policy, I said policies. Multiple policies. A lot of people, when we're on the phone with them, say, should I start one policy or should I start a few policies? The answer is always going to be one. You want one policy on the breadwinner. You want it on the golden goose.
Hey, Daddy, I want a golden goose.
But a lot of people think more is better. And they might think that because oftentimes myself or Brent or someone else on my team says we have, X amount of policies. Like I have 11 policies. Brent's got like 28. Devin's got like 10 or 11 too. And they think that we have more, so they should have more too. But we don't have more policies because we want more and because it's more advantageous to have more than one. We have more policies because as time has gone on, as we've made more money, we've wanted to put more money into our banking system, our private banking system. Therefore, we've needed additional policies, or like a traditional bank, additional branch offices. So that's what we're going to talk about today. We're going to talk about your private banking system and how many branch offices should you have. Now let me ask you a question. If I asked you, would you rather have a goose or 3 golden eggs? What would you say? Would you want the goose or would you want the golden eggs? Now, most people would say they want the golden egg. Well, let's just associate the golden eggs with the things in life we want. Those are the cars, right? One gold egg represent your dream car. Another one's your dream house. Another one's something else you've always dreamed of having. So those are the 3 golden eggs. And in life, golden eggs are just all the things that we want, like the luxuries we want to own, the things we want to buy, maybe even investments you want to have so you can have passive income or whatever it might be. What did it take to get those golden eggs? The goose. A very special goose, but you needed a goose to lay the golden eggs, right? So if I asked you now, would you like the goose that lays the golden eggs or would you like the eggs? Your answer would be very different. You'd say, I want the goose all day long because the goose can just keep laying golden eggs.
Egg the what?
The egg decatur. The egg decatur can tell the difference between a good egg and a bad egg. If it's a good egg, it's shined up and shipped out all over the world.
Yes. But you must take care of the goose, you must feed the goose, water the goose, clean the goose's cage or pasture. You gotta tend to the goose, right? The goose, if you haven't figured this out, is you. You are the goose that lays the golden egg. So would you rather invest money in golden eggs or in the golden goose? It would be the golden goose, it would be you. This is life, folks. You can have as many golden eggs as you want if you continue to invest in yourself, because you are the breadwinner, you are the golden laying goose. That's right. And the more gold eggs you want, the more you must invest in yourself. With that being said, everything that I teach about the infinite banking concepts is about knowledge. It's about learning a new skill called the infinite banking concept, a skill that does indeed allow you to lay more golden eggs. But the golden eggs that you get to lay can be much more efficiently had. And how is that? Well, you can use things like compounding interest. You can use things like velocity of money. You can use things like tax-free environments and all sorts of other things in order to have more golden eggs. But it all resulted in your knowledge about how to make the goose more efficient. And that's exactly what we're talking about today. We're talking about the golden eggs, all the things you want to buy in your life. And what's it going to take to buy all those things? Well, of course, it's going to take more money. The difference is how you're going to acquire that money. Some of that money, a large portion of that money, is just going to come from you, the goose, going out and working your tail off, doing what you do day in and day out, working longer hours, more overtime. Yes, that's all part of it. But the other part that most people don't realize is that the golden goose can gain some knowledge to learn not how to work harder or work longer, but to learn how to work more efficiently, or better yet, to learn how to have those golden eggs work harder than they do. The goose may not need to go out there and work harder. The goose, you, might actually find a way to make your money work harder for you. See, your money doesn't have restrictions. I mean, you, the goose, you need to sleep, you need to eat, you gotta go to the potty, you gotta do all sorts of things, and all those things takes time. And there's only 24 hours in the day, and you sleep for at least 8 of those 24 hours. So You are not very efficient just in the sheer nature, but once you gain the knowledge of how to make your money work for you, now your money working for you has no restrictions. It can literally work for you 24/7 without interruption. Uninterrupted compounding interest is an example of that. Unrestricted growth, unrestricted compounding. No breaks, no sleep, nothing interrupting it. Because your money can do that in that efficient manner, it can go out there and earn you more golden eggs. You, the golden goose, doesn't have to go out there and work any harder or any longer. It's your money working for you. So that's what we're going to talk about today. But we're going to parlay that back to you learning how to be your own bank and you learning how to expand your private banking system, which then allows your private banking system to spit out more of those golden eggs, which are what you want. So with that being said, there's a lot more to unpack with this, but before, I want you to click that subscribe button. And there's a little golden egg right up top. Yep, that looks like this bell. It's a little bell, it's gold, I think, or orange, or whatever color. Smash that bell. And what will happen is once you smash it, a whole bunch of golden eggs will fall out of the sky right into your lap. So let's dive in. One of the things that I'm talking about is building a private banking system. And that private banking system requires you to change one thing, and that is where your money goes first. Because we want to earn uninterrupted compounding interest. We want an effective place for our money to go where it can work 24/7 at whatever we want it to work. Well, it can't go to a traditional bank and do that. Because a traditional bank is in the business of making money by making your money go to work for it. You see, we must change where that money goes the same way that the Rockefellers, Rothschilds, the Morgans, the Stanleys, Ray Kroc, Walt Disney, and the sitting dude, the Biden man, did. Anyway, I don't even know why I still use his name, but yeah, all of them used the same place as a storage of their wealth. They all became the bank, and they used giant mutually owned insurance companies. And they didn't just put money in those giant mutually owned insurance companies, they actually put it into a specially designed whole life insurance policy, which then gave them the ability to earn compounding interest on an uninterrupted basis. They put money into the policy, they then take the money out and they go out and make that money work a second time without interrupting the original money they put in the policy. How can that be done? Well, it can be done because in the contract of the whole life, you have the ability to take loans from your policy, but when you take a loan from your policy, your money never leaves. Kind of like, your house. When you get a home equity line of credit on your house is worth, let's say, 500 grand, you got 200,000 in equity. But when you get a home equity line of credit and you borrow $200,000 from your home equity line, does your house decrease in value? No, it's still worth 500 grand. You still got 200,000 in equity. You just use the equity. Okay? In the whole life, you're just using the death benefit early before you die. And the insurance company is glad to lend you part of your death benefit because they're going to charge you interest. When you borrow money from a home equity line of credit, the bank, don't they charge you interest on that? It's the same thing, but your money stayed in your policy earning interest and dividends. I guess you could parlay that to a traditional bank. If you got a home equity line of credit and a high yielding savings account, if you don't touch the money in the high yielding savings because you can use the home equity line, isn't your money compounding uninterrupted while you use the home equity line? Yeah. But you see the big difference between that scenario and the whole life is the whole life does it in one place. You don't need a home equity line, which you got to qualify for and the bank can take away from you. And you don't need a bank account paying you interest that can go down or up in interest, more likely to go down than up. You have a contractual guaranteed interest rate in the policy contract, and you have the ability to use up to the amount of cash value anytime without any questions, without any qualifications. See the difference? Back to the place where your money should go first, which is the specially designed whole life. How many of those should you have? Well, I don't know. One, right? I have one life, therefore I need one policy to secure my life insurance portion, and I need one policy to dump my money into. Right. Up until you can't put any more money than what the policy will allow under MEC guidelines. Now that's too technical for today's purpose. So just think of it this way. If I set up a policy and I want to be able to save $10,000 per year into that policy, great. I can put 10 grand into that policy. I can put less, but I can never put more because I have rules, IRS rules called the Max 7 pay. So now I got one policy that has the capacity to hold 10,000 bucks. Awesome. And then I put 10 grand in, I take money out, I make it go to work a second time, all's good. But what happens when next year I want to save $20,000? I have a policy that will hold 10. What do I do with the other 10? I have to expand my banking system. So now, just like a traditional bank, if a traditional bank wants to expand its money supply, what does it do? Opens additional branch offices in different parts of town, in different cities, in different states. That's what they do. They expand their footprint of their bank. You now own a bank because you're going to think like a bank. So you have a private banking system, and if you only want to save $10,000, you only need one policy that will hold $10,000 in premium deposits. But if you want to save 20, you're going to need 2 policies, 2 branch offices. And as you go through your life, your capacity to save money will increase. It just will. Why? Well, you'll probably get raises through work, maybe you'll get bonuses, but your money will continue to work for you 24/7. So therefore, your money will create more money, which will then create more of a need for additional capacity to save. So what are you going to do? You're going to open more policies, more branch offices. Throughout your life, you will expand your private banking system, which means you will expand the number of policies you have, which will expand your capacity to have more money working for you and more money earning uninterrupted compounding interest. Does that all make sense? So why would you want more policies? Only one reason for that: to have more capacity to save more money. That is it. Which, when you save more money, what also happens? You have more money that you can take as a loan. And as your cash value builds from compounding, additional savings and premium deposits and all that, you then can have more and more money going around the little circle that you always hear me talking about, the infinite banking concept. Your money starts on the left. Actually, let me give you a visual. Your money's over here in the policy or policies. Then we're always going to take money from our policies in the form of a loan. Then we're going to borrow our death benefit, and it's going to go over here. And I do lending. I do private lending. So I lend money out at 12 to 15%. That 12 to 15% interest I get from my money working for me then goes around the bottom part of the circle and lands back in my policies as a loan repayment. Because remember, I took a loan for my death benefit, so as I make money on my money, that made money comes back over and replenishes the money that I took from my death benefit, reducing the amount of loans I have with the insurance company, reducing the APR of interest I paid to the insurance company, while my money then starts to expand and give me the ability for more to keep going out and working, and around it goes. The faster it goes, it's like Monopoly. Every time you pass go, you get how much? You guys all remember Monopoly, right? Jordan, how much is it every time you pass go? 200 bucks. Here's 200 bucks every time you pass go. How many times do you want to pass go? A lot. But in Monopoly, is that the name of the game? Is it just get around the block as fast as you can? No. You enjoy the journey. You stop on all those little things, and eventually you buy some real estate, and that real estate is your money working for you. And what happens? It produces rent. And as that rent comes in, you buy more as you go around the block, and then you get 200, and you just keep going round and round. The infinite banking concept is very similar, except for you do it in a very different way. You continue to expand your capacity to save money. That's why you have more policies. That's all you're trying to do, is increase that velocity of money that you have to work for you. That's it, folks. There is no other answer except for maybe one. Let me just give you one outside the box. You got a husband and wife, okay? Both of them are breadwinners in the family. Both of them work and support the family, not just one breadwinner. But you have 2 geese, husband and wife, in the household. Both of them are laying golden eggs, okay? So what do we need? We now need the capacity to hold more money for 2 gooses. We can't have something happen. If one of the gooses, dies too early, we got a problem. Now we only got 1 goose laying a golden egg. So we want to protect 2 gooses or geeses or geesins or, geese with 2 policies. Holy cow, I butchered that. I hope you've enjoyed this video, folks. And if you like this one, check this video right here. It is called the Money Multiplier Method. We'll see you on the next one.